I'm Tara Lynn Wagner. You may not have a rich uncle eager to foot the bill for your college education, but many students and parents do have an Uncle Sam who's willing to lend a hand. For one thing, there's the American Opportunity Tax Credit, which offers a maximum tax credit of $2,500 per college student per year, depending on your household income.
Because there are phase outs, so when your income rises to a certain level, you would not be able to take the credit. So sometimes it's beneficial if the student has income and they're not claimed as a dependent on the parent's return for them to take the credit.
Even better, the credit is refundable, meaning if the person claiming it actually owes less in taxes than the credit is worth, they can get what's left over handed back to them, up to $1,000. The other credit is the Lifetime Learning Credit, worth up to $2,000 per tax return, not per student. This one is also good for continuing education and professional development courses. Remember, with credits, it's one or the other.
You cannot double dip.
There are also a variety of deductions that can help reduce your tax bill, like the interest you pay on your student loan.
The maximum deduction is $2,500. It can be taken by the student if it's the student's obligation, or the parent could take the deduction if they took out the loan while the student was a dependent of theirs.
You can also deduct some of what you pay in tuition and fees, as well as the costs of work-related education expenses, meaning classes or training that's required by your employer or relates to your current field. Finally, you can avoid paying taxes in the first place by investing in either a 529 plan or Coverdell Education Savings Account. Yes, you're investing after-tax dollars, but
it allows the income to grow tax-free, and when you start to withdraw the money, both the principal as well as the interest is not subject to income tax.
As long as it's being used for a qualified education expense, like tuition, room and board, or even a computer.
If you take the money out and you don't use it to pay qualified expenses, then the income is going to be subject to tax.
Plus a 10% penalty. For Money Matters, Tara Lynn Wagner, New York 1.